Hi everyone, good afternoon, good morning, whatever time it is over there. Welcome back to my YouTube channel, the last edition for February of the Expert Spotlight series. Drum rolls. So today, on today's edition, we have Annie with us, like Annie Doza, like he likes to be called. So Annie Edbert is someone, I don't know if it's safe for me to call him my friend, but it was someone that I met like last year when we went for this speaking engagement at LASU. And I was like, who is this guy? Who is this guy? So I was like, so when I started the Expert Spotlight series, I knew that I had to bring Annie on board to come and train us on any topic of his choice. With me this morning is Annie Ebert. He has like quite a number of years of experience working in the Big Four. He currently works as a senior business process consultant at Deloitte, and he's a chartered accountant and is one of the very smart people you would see on the internet these days. Welcome on board, Annie. How are you feeling this morning?
Making my head to swell. Thank you so much, Pepe. It's such a privilege to be on this platform with you. I mean, you're one person I really admire. I mean, when I began to be serious with LinkedIn, I looked out and I was like, who is this Perpetua? She was always giving us quality content every day, and she eating the thing. I was like, no, this is an excellent person. So it's quite a privilege to be in the room with you, and I don't take it for granted. Thank you so much.
Thank you so much, Annie. Okay, so before we go into the tutorial, there's a question I want to ask you. So there's this, will I say, controversial topic. So a lady came to our group chat because we have a community group, and she said that she got a job offer from a bank she's a fresh graduate, right? She got a job offer from a bank that was willing to pay her like 150,000 naira per month. And then she got another job from an audit firm, or this small, medium-sized audit firm that was willing to pay her 50K. Yeah. Exactly. That was willing to pay her 50K. So I don't know, she was asking older professionals, what advice do you have for her? Do you think she should go for the bank job of 150K, or she should take the audit firm offer of 50K? Please don't forget we are in Buhari's economy. Sorry, we are in Tinubu's economy. Please, as someone that's seen it all, I mean, you didn't start with the Big Four, you started from one of those firms.
No, I didn't.
You work with SAP, you work with all of these firms. What advice do you have for such a person? Would you say she should take the bank offer or take the audit firm offer? Let's hear your thoughts.
Well, it depends on the person's career goal, right? So if the person's career goal is to build competency and a brand in the banking space, then that could be a consideration. What role is she offered in the bank? Is it someone who is going to do teller, those people that stamp teller, or customer service, or what exactly is the role? If it is, say, maybe an internal control role, or credit risk manager, or some of those account-related stuff, and it's in line with her goal, I mean, she could consider it. But if the person wants to build consultancy experience, it is a difficult advice, but the truth is the ANCO may be better. You see, there is one adage that guides my choice. It's always seek to make impact, and income will follow. Every time you learn, you stand a chance to earn. But if you want to pursue the earning, you might be weary in the process of earning, and you don't have the chance to learn. And when your learning aptitude reduces, your earning ability reduces. So I would like to say, what is the person's goal? If you want to be a consultant, please go for the 50K. You won't be in ANCO for long, but you'll be exposed to a lot of opportunities here. So that's my recommendation.
Okay, so I hear you, but then you kept saying if the person wanted to become a consultant. So let's say for someone that just wants to be an accountant, well, I don't have dreams of becoming a consultant. I just want to be an accountant. I did BSc accounting. Would you still advise that I should go for ANCO or banking? If my long-term career goal is just to be an accountant, not to concern people's consulting, right? I just want to be a good accountant. You get?
Yeah. So again, it will also depend on what kind of accountant do I want to be. If I want to be an accountant for a small company, I'm looking at being part of a CFO for top organizations. Now, recruiters they consider the pedigree of organizations you've worked with. There are some recruiters that will consider you for a job because you've worked with a bank instead of Anamco, because Anamco is not a known name. But there are some other recruiters that will consider you for a job because you've worked with them. Because of their pedigree, they probably trust that someone who has worked with probably an audit firm has gotten wider experience, can manage different engagement and all of that. So first is to sit down and plot the graph. Where am I going to? Where am I looking at? Am I looking at ending in a big maybe company as their chief financial officer or chief or the CFO or something? Then I might have to also look at building my career within a known brand. In that case, so if a GT or a Zenith offers me a job, Zenith is a big brand, GT is a big brand. And if I put in my CV that I worked with a GT, sometimes it could be the catch for me. So, and I worked as a finance person in GT. Oh my goodness, I've gotten it. So again, the person has to look at those other indices and make the choice.
Thank you so much.
So if I were to choose, let me try to answer with the choice. If I were to choose, let's say my goal is to work with a big FMCG company, and I know that most of the people that head the account unit in FMCG companies must have been maybe chartered accountants that have the ANCO background. In that case, and I consider that a job with ANCO will give me broader opportunity. I could maybe prepare accounts for FMCG and ANCO and all of that. But if I'm considering maybe a tech company or mostly tech companies, and I mean, my experience with the banking sector might be very useful. And of course, the banking brand is big enough for maybe bigger tech companies to consider. Yeah.
Wow. Thank you so much. I feel like this is the most extensive answer that I've gotten. You know, when you ask people this question, everybody just says, of course, go for the ANCO now. Are you not chasing knowledge? Don't chase money. Nobody really sit down and ask. You know, sometimes they make it look like if you start your career in a bank rather than an audit firm, you can never make the most out of your career, which I do not subscribe to. I mean, the ANCO has the advantage, but there are people that are doing well that don't have audit background. They've never worked in an audit firm, and they're like CFOs of great companies today. So thank you so much. I love the way you've analyzed it, and then whoever would watch this video, they know what to look out for in making this particular decision. Thank you once again. I think we can move to the tutorial now. So guys, Annie will be taking us on the ABC of accounting ratios. I'm very, very excited about this particular topic because it is very important for those accountants, that you just prepare financial reports on Excel and then share with your management. No analysis, nothing. Please drag a seat and your jotter closer. Let that thing change. You need to do better. So Annie, thank you once again. You have the floor. Please do your magic.
All right. Thank you so much, Pepe. I should say good morning, good afternoon, good evening, everyone, wherever you're connecting from. I'm just so glad to be here with you guys, with Pepe, this privilege. So we're looking at ABC of accounting ratio. It's ABC, not XYZ. So it's going to be very simple, very relatable, and very practical. Yes. Okay. So don't be afraid. You know, some people don't like computation, all these percentage. They don't like all those wahala. Just put the debit and credit and send the thing, and that's the end of it. And I mean, one of my favorite examination questions were usually accounting ratios. If I see accounting ratio in ICANN, I'm good. I'll just match the thing and move. So they were usually easy to deal with. So I'll just look at some basics and some things that will make your accounting report make sense, some things that will be useful if you're writing the ICANN exam or the ACCA or whichever professional exams, or even you are in you're currently an undergraduate in university, you would definitely need this knowledge. So whichever level, whatever age, whatever experience, accounting ratio that I'm sharing today, the ABC is going to be very useful. So hang on, and then let's take a ride. Okay. All right. So this is a very concise content I'm going to speak on. Don't mind that it's 28. It's very simple slides. My slides are not plenty like that.
Okay.
So, right. So when you hear ratio, technically, what comes to mind is percentage. And you know why ratio analysis is very important? Because we think pictures and proportion. We think pictures and proportion. Anytime you are able to put your thought within picture and proportion, you usually make a larger decision. For instance, if somebody says you've been sleeping for 8, or if somebody says you've been sleeping from 8 p.m. to 8 p.m. to maybe 6 a.m., that should be like how many hours? Over 12 hours. Been
Mm-hmm.
sleeping for over 12 hours. Sometimes they might not ring a bell. But if somebody say you've been sleeping for over 50% of 24 hours, like it means you've spent over half of your day sleeping.
Yeah,
My goodness, it will start ringing a bell. So that's
exactly.
what exactly, you get the point. So that's what ratios does. They help you think in proportion. If you say my business doubled its revenue, or we did 50% increase, or we did 30% lower, it helps you think a little bit in proportion. So sorry, I have a light out right
Oh,
now.
so sorry.
Um, yeah, so let's continue. So it helps you think a little bit in proportion, and then you're able to make good decisions. So financial ratios help every accountant and financial analyst to decide or appraise or assess the financial health and performance of the company. So I think generally we have like 4 categories of them. We're going to look at them in subsequent slides. But in this presentation, we will look at the financial ratios, we'll look at their interpretations, we'll look at practical applications that can enhance your understanding of how to use financial ratio. Okay, so let me move to the next slide.
Okay.
All right, so this is why financial ratio. Like I mentioned earlier, we think pictures and proportion. So first, it helps you evaluate performance with ratio. You can so imagine, that value added as an accountant, that you're not just giving your boss financial
Mm-hmm.
reports, or you're not just giving
Exactly.
PRL. You say, okay, between last week and this week, our cost has increased by 40%. We need to check what those guys are doing in the back.
Mm-hmm.
Between you get that is value
It's like
added. Your guy
you've
will be,
been there before. You've been there before.
you understand? So be like, our money came in, maybe something happened, or this is so we think in percentage. So it helps to evaluate performance. And then, very important, it helps in comparison. Whatever is not
Yeah.
measurable cannot grow, and whatever cannot be compared cannot be measured. So with ratios, we can say, okay, last week this was our position. This week this is our position. This is how better we are getting, or this is how better we are becoming with our business and all of that. So it helps in talking. It also helps in decision making. You see, ratios assist in making decision. You would know whether to continue a process, you would know whether to stop a process, you would know whether to increase a cost, or you would know whether to eliminate certain costs, certain products that are not. You just look at the numbers, you look at the percentage, and then you make decision. Got it. And of course, you can forecast. When there's a trend, you can always forecast. If you notice that if our operating margin increased by so percent, then our return on capital engaged on capital employed was this percentage. So you notice the relationship between a particular this and that. So you can say if I increase my profit, or if I increase my profit margin by this percentage, I can also increase my return on capital by this percentage. So it helps in forecasting. You can tell what to tweak for you to have a certain kind of result, right?
Yeah.
Okay, so let's look at types of accounting ratio. I just keep it simple with the basic 4. Usually, this is what you always have to deal with:
Mm.
liquidity, solvency, profitability, efficiency. liquidity. Is to be able to say, I'm not liquid, I need more cash. I think in this economy, there's so much of liquidity issues. So liquidity measures company's ability to meet its short-term obligation with its current assets, right?
Yeah.
So you look at how can we meet our short-term obligation if all our creditors now, like say the current liabilities, all our creditors will say, oh yeah, people should pay today, today, today. What's the state of our liquidity? Can we cover our can we cover all our obligations? Sorry, excuse me.
Yeah.
Short-term obligation, how well a company can cover its short-term obligation. Solvency looks at long-term financial stability and obligation. So how well can you meet your long-term obligation and how well are you financially stable on the long term? So basic ratio we would look at here, I will just keep it simple, like I said, debt to equity ratio and interest cover ratio. Then profitability ratio, this one has many profitability ratio, yes. So they help you evaluate your company's profitability. This, like I said, is a go-to. This should be your handy ratio. I mean, you want to know that you're profitable, you're still in business. I mean, who want to continue in business when they are profitable? And
Yeah,
let
if you
them
are
know
not
that
for
they are
profit now,
profitable.
you can be doing
Yes.
giveaway.
No, no. So, and I mean, it's okay to let your business know that they are doing well. If they are actually doing well, wow, boss, we actually made we did about a 30% increase in revenue. We did a 30% increase in profit in the last 1 week, in the last 1 month. This is very recommendable, and this was as a result of this, and that. That is what ratio analysis is all about. Yeah. So what I would actually look at on this call is gross profit margin. We look at net profit margin. We look at return on equity, and then finally we'll look at efficiency ratios. And to wrap it up, I will just do a quick run through on how you can just build the formula into your Excel. Just have your financial statement, have your ratio portion on your worksheet, however you want to design it, is left for you. So that every time you impute your revenue and all this other data, your ratio will be updating automatically and you can always
That's
have
really
it.
nice.
All right. Okay, so we go to the next slide. Calculating ratios. So on a high level overview, these are the four ratios and how to calculate them. So for liquidity ratios, there are several liquidity ratios out there, but I think the basic ones for me, this is ABC, the basic ones for me should be your current ratio and your quick ratio. Your current ratio is how much your current assets can cover your current liability. So it's basically your total current asset over your total current liability, right? So if, okay, when we get in, we'll speak more about that. Then your quick ratio, that one is more of how your cash and other securities can cover your current liability. Your quick ratio is your current asset minus inventory over current liability. And then we also have cash ratio. That one is strictly cash and marketable securities, right?
Okay.
Yeah. Then solvency, we have debt to equity ratio, what I call DER. That looks at your total debt over your shareholders' equity. So this one says how much of the company is financed by debt and how much is financed by shareholders, right? So it compares your total long-term liabilities to your equity value. Then we have the interest cover ratio. This one compares how well you can, you can cover your interest on debt. Of course, when we're talking about debt, we're also talking about servicing the debt by making regular interest payments. So sometimes it is okay to check how much of your current state of profit can cover your interest expense. That is what interest cover ratio is about. Please, Feel free to tell me if I'm too fast or if
No,
I'm
the pace is
speaking.
fine.
All right. Then profitability ratio. Yeah, like I mentioned earlier, we look at gross profit margin. That's revenue minus cost of goods sold is your gross profit technically. So I had to break it down that way so that our people that there are some people that are currently accountants that did microbiology. I hope you know that.
Yeah, true.
It's either economy or change of passion, but whatever the case,
Yes,
whatever the
I
case,
get.
whatever the situation, this is ABC. So don't worry about the technical thing. Gross profit
Mm-hmm.
is revenue minus cost of goods sold. So that's technically your gross profit over revenue, and then your net profit margin, net profit over revenue, and then return on equity is your net income over shareholder equity. Then efficiency ratio. We have your inventory turnover ratio, and then we also have your account receivable ratio. I know there are some other ratios out there, but when we get into each of these, we might consider the other ones. Now, these are facts and circumstances you should always remember.
Okay.
When it comes to calculating financial ratio, garbage in is garbage out. So your data has to be accurate, reliable, and consistent. If not, what you put in is what you see.
Mm.
Very important. Very, very important. I mean,
Yeah.
do you know that 1 0 in it? There was, I recall a case of, trying to analyze the financial statement, and the preparer had forgotten that, when we do financial statements, sometimes we abbreviate, like we can put 000 on top and then
Yeah,
put
yeah,
the
yeah, yeah.
thousand equivalent.
Mm-hmm.
Ah, it was just that zero that was the wahala. The zero, one additional zero was
Hmm.
what threw up pressure. You ask, how come I'm reporting net profit of this amount and then I'm seeing profitability of over 100%? What happened exactly?
Yeah.
So please ensure that your data are accurate. And then also consider industry standards and benchmarks when interpreting ratios. That is very, very key. Very, very key. So you have to check your industry. Don't worry, we'll talk more about this as we proceed.
Okay.
So let's look at the first on our list, liquidity ratio. I have four here:
Mm-hmm.
quick ratio, current ratio, cash ratio, day sales outstanding. Now, people hardly use the day sales outstanding. Yeah, people hardly use that. But for a normal business, your current ratio, your quick ratio, your cash ratio has to be handy. Now, I've provided the formula for each of these. Do I have like a whiteboard option here where I can
Hmm.
um,
On Zoom, I think there is. Should be.
let me see. Does it look like anything is
Yes,
moving on my
yes,
screen?
yes. You're circling something.
Oh, great. Great, 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 great. All right. So, let me see the one I would love to use. Use the color too. Great. All right. So basically, this is our current ratio, current asset over current liability. And like I explained earlier, your current ratio tells you that you are able to pay off current liability with your total assets, such as your account receivable, your inventory, your cash, and all of that. So if we put all our total assets, total current assets together, and let's say tomorrow our creditors they come and say people have to pay me today, or we even want to check that as it stands, can we comfortably pay our creditors within 1 year because current liabilities are supposed to be 1 year. Can we pay off
Yeah.
our trade payables, like our accruals, all of that, everything that comprises of our current liabilities? Can we settle
Mm-hmm.
them within 1 year, considering the state of our current assets? If your current asset over your current liability is one, it means you are 100% okay. Like if you settle your current liability, your business will be at zero liquidity. If your current liability is 1 point something, you are at a very, very good state. But if your current ratio is 0 point something, sister, brother, there is a problem. So
Mm.
you need to, these are the practical application. Then quick ratio, yeah, this one is like the name implies. I think Another name for this is the acid test ratio. Yeah. So
Yeah.
as the name implies, this one looks at if I take out my inventory, because inventory is beyond your control. Inventory, you cannot tell whether people come and buy the goods tomorrow, but you shall hopeful that they will buy it within 1 day, right?
Yeah.
So, but if you take out that one that you know you cannot control, you take out inventory. What is the possibility of you covering this? And I love the way CFI Institute learning something I can't recall, but I love the way they put this. They said in the order of strictness, current
Mm-hmm.
ratio is lenient, quick
Yeah.
ratio is strict, cash ratio is stricter. So if you want to say,
Yeah.
and it's
Yeah.
true actually,
Very
because you
true.
notice the progression. In current ratio, it is your total current asset. In
Mm-hmm.
quick ratio, it is your current asset minus inventory.
Yeah.
In cash ratio, it's only cash. So you see
Yeah.
the progression, you notice the progression that as you keep moving from each of them, the criteria for determining your liquidity gets strict. And of course,
Yeah.
cash ratio is usually the best measure because cash is fully at your control. Cash is
Mm-hmm.
perfectly at your control. In other words, you can easily access cash compared to inventory, compared to receivable, which is even
Yeah.
the tendency that you want to go and collect your debt and
Exactly.
you get you get. All right. So these are there, and then these day sales outstanding. This refers to the average number of days it will always take a company to collect payment after it makes sales. It's more like analyzing the tendency of your trade receivable and all of that. So a high DSO would always mean that the company is taking an unduly long
Fine.
period to collect payment. And you know the implication, capital tire, the implication is capital tire, right?
Mm.
All right. So we go to the next slide.
Okay.
Any questions so far? Any?
None. None.
Okay. So, um, so we look at solvency ratios, and two ratios that I would like to speak to is debt to equity ratio and interest cover ratio. And then we'll look at how this is applicable, for you as maybe a student or an accountant or whichever role you are. So
Mm.
your debt to equity ratio measures the proportion of your company's financing that comes from debt compared to equity. Now, I had mentioned this high level before. So we look at our debt, we look at our equity. What proportion is what proportion of our business is financed by debt? What proportion is financed by equity? Right. So, but just to ask, what do you think? Like this is practical. Let me just
Mm-hmm.
hear from you. What do you think is a better position? Is it a higher DER or a lower DER?
So for me, I would say that you should always strive for a balance. So if you
Okay.
should always there's something they call optimal capital structure. You
Mhm.
should always strive for an optimal capital structure. And if the thing is, when you use debt financing, there are advantages, like the interest
Yeah.
is you can easily
Yeah.
get debt financing, then the interest is tax deductible and all of those things.
Yeah.
Then if you use equity financing as well, it has advantage and disadvantage. You are diluting the owner's control because you have to bring in more shareholders, the cost, and then the return expected. So as a business, I feel like most what I know is probably it should be like maybe 50-50. 50-50 is fair, but I feel like that might not always be the optimal structure for every business. Before you can decide on an optimal structure, look at the perks of each of these. If you want to take more debt, what are the advantages and
Yeah.
disadvantages? If you
Yeah.
want to issue out more equity, what are the advantages and disadvantages? I think that's just what I have to say.
Absolutely. Absolutely. Perfect. Perfect. So, initially when I was growing up, I don't like wahala. I don't like problem.
Oh,
And I used to consider debt
wait.
as
Do you
wahala.
like wahala now? You said growing up. Is it that did anything change? Do you like wahala now that you are grown?
No, no. Let me define the context of wahala. I don't like owing people. I don't like debt.
Okay.
And it doesn't used to make sense for me when businesses are, incurring debt. And
Hmm.
I'd never wanted to see an advantage to debt, right?
Hmm.
Like, I'd never wanted to see an advantage. But I mean, growing up, coming into the business world, I even got to understand that, debt could be a very strong advantage if well managed. It could
Yeah.
assist your capital structure. It could also even help you for tax planning and all of
Mm-hmm.
that. So, the advantages and disadvantages to everything. So you just choose the one you want.
Okay.
All right. So for DR, the formula is total debt over shareholders' equity. The formula is total debt over shareholders' equity. Now, I've put here on the highlight that a high DR indicates that the company is using more debt to finance its operations.
Mm-hmm.
So it means if I have a higher debt to equity ratio, it means that I'm using more debt to finance my operation, which can increase financial risks due to
Yeah.
higher interest payment and difficulties. I don't know what interest rate is currently in Nigeria, especially with this proliferating increase in exchange rate, high inflation rates, things are just going high. I don't know what interest rate is currently, but usually this is the risk of debt financing, usually interest. I think aside interest, that interest is one of the biggest risks. So one of the things to consider when you are debt financing is what is the interest rate, what is the interest payment, and how much is this going to affect my company's profit? How much is going to even affect the retained earnings that's available for distribution to shareholders, right?
Yeah.
Or the profit available for distribution to shareholders. Then on the other hand, a lower DR suggests a lower level of financial risk and a stronger solvency position. All right. So another one is interest cover ratio.
Okay,
Why I consider this? Okay.
before you go to that
Yes.
interest cover, can I ask a question? So for this debt,
Sure.
you said it's total debt over shareholder equity. Just to confirm, that's the addition of your current liability and your long-term liability, right? Or do we just consider
Yes.
only long-term liability?
So I think as a best way of defining this, I would say interest accruing debt.
Okay.
So debt that you have to make interest payment on.
Oh,
So
okay.
there could be debt within your current liabilities, right? You could have short-term loans, even if it's short-term loans, and you have interest payment on that. That's the debt
Okay.
financing. And then
Okay.
you also have long-term loans and all this. So it could be your short-term plus long-term, followed by shareholders' equity. It could also be only your long-term, depending on the debt that you have on the company.
Okay, that makes sense. Thank you.
Yeah. All right. Yeah, thank you too. All right. So interest cover ratio. Of course, when there's debt, you always have to service that debt by making interest payment. So this interest cover ratio assesses a company's ability to meet interest payment on outstanding debt. And usually the formula for this is your operating income all over interest expense. Now, this is um, a very key analysis. This is a very key analysis because you would want to know that my operating income can actually cover my interest expense. Otherwise, it
Hmm.
means you're not running a sustainable business.
Yeah.
So these are indices that could all, have this thing at your beck and call into. You'll be giving us the experts. This is called expert spotlight session. You'll be giving expert recommendation and advice to your boss
Exactly.
or whoever you are dealing with, right?
Hmm.
So now let's look at applications. With your debt to equity ratio, you can you can understand your capital structure and financial risks. You can understand your organization's capital structure and financial risks. Are we more debt financed or equity financed? Are we in a risky financial position? Can our operating income cover our interest? By analyzing changes in your debt to equity ratio over time or comparing it to industry benchmark, you can evaluate your company's leverage levels. I mean, in ICANN, when you hear with the appropriate or with the adequate leverage ratio,
Mm-hmm.
can you discuss the stability or the financial risk of the company? You know, all of those things. You just know all those things in English is debt to equity ratio that you need to just
Yeah.
calculate and see if this company is going to be sustainable in the next, in the next foreseeable future, right? So a company with a high debt to equity ratio may have higher financial risk because it relies more on debt financing and may also have difficulty in servicing its debt in adverse conditions. So these are things that we need to always check out when we are providing our analysis. So let's go to profitability ratio. Let me ask you, Peps,
Okay.
what's your most favorite profitability ratio?
I think it should be net profit margin.
Why?
Because that's like I feel like gross profit can be deceiving because you might think you're doing well when you're doing gross profit margin, like, oh, we made a lot of money, but then you're forgetting that there are overheads and there are expenses. So I like to look at things from like net profit, which is what is left after we paid all our expense, right?
Mm-hmm.
So that net profit
Mm-hmm.
margin shows you like a true picture of you make sales of 1 million. Out of that 1 million, what is left for
Yeah,
the business is just 10,000 naira.
yeah,
So there's a
yeah,
problem. You
exactly,
understand? You get so yeah.
exactly.
For me, it's net profit margin.
Exactly. And that's why, as accountants, you need to also start thinking from disposable income perspective. You see, people sometimes they make plans with their total income, not disposable income.
Mm-hmm.
And as a business, you have to make plan with your net profit. Yes, I know. Like when I mean plan, I mean like growth plan. Yes, because you can
Yeah.
only expand your operations to the extent that your net income can accommodate. And same
Yeah.
thing. So the next time they increase your pay, don't just go and start increasing your expenses. So check your disposable income.
Exactly, exactly.
uh, okay, so um, I have three: gross profit margin, net profit margin, and then return on equity. So for me, I think I align with Pep's NPM. I love net profit margin very well because it tells you how well your company
Mm,
performed overall. Yeah,
yeah.
it tells you how well your company performed overall. Gross profit margin is more like primary comparison. So if we are comparing our company's performance based on its what is this thing?
Benchmarking.
Not benchmarking, its essence. Like the reason why a business is the reason why a business is in operation is business objective. Yes. So
Okay.
if we are comparing based on our primary business objective, so
Mm,
my primary business objective is to manufacture and sell, say maybe cocoa. And by the time I check my cost of production compared to my revenue from sales of cocoa, what's it like? So that's what gross profit margin speaks to, right? It looks at the percentage of revenue that exceeds the cost of goods sold, and it's actually a good way um, to evaluate how efficiently a company is producing goods or services, how efficiently it is pricing, and all of that. And usually, a higher gross profit margin could indicate that the company is managing its cost of production well, or a company is pricing very well. Company
mm.
is pricing very, very well. Yes, it's pricing very well. Sometimes we used to take it to price. Speaking about myself, but all right.
Okay.
Okay, so then net profit margin, of course, this is your net profit over your revenue. It takes away all the other operating expenses, interest, tax, and all of that, and just looks at what is the net income compared to the revenue. Of course, your net profit margin would always be lower than your gross profit margin, except you do
Okay.
not incur any expenses.
Mm,
Yeah. So a higher net profit margin will always indicate the company is efficiently controlling its expenses generating more profits from its overall operations, and all those kind of things. And then a very important profitability index for especially engaging shareholders or business owners is returns on equity. Every business will want to know what the returns on equity is like. And this measures the return generated on shareholders' equity. It's usually your net income all over your total shareholders' equity. So if we look at our total net income for the period, and then we want to share that among our shareholders, what's going to be the percentage like comparing our net income to our shareholders' equity, right? And a higher return on equity indicates that the company is generating more profits for its shareholders relative to equity invested in the business.
Let me just add something. This return
Yes.
on equity, I actually love that ratio. You know why? So I used to work in a startup at some point, and then I learned ratio analysis. I was the only accountant. Then I always wanted to do more than just preparing financial record. So I remember that one month after I'd gone for training, I prepared our financials. I did gross profit margin, net profit margin, and then everything was looking good. We were making like maybe 30% margin, net profit margin. It was still fine until I did an ROE, return on equity. I realized that it was even better for us to carry our money and go and drop in the bank because we're not making enough return. Because how I try to see things is if I invest 100 million in my business, I can as well put that money in fixed deposits. I will get like maybe 16% or 17% interest. If I am putting it in a business and I'm not getting up to that amount, then what's the point? I know that we might also want to look at longevity and all this, but looking at it like temporary, like I was like, I had to now sit with management and look at it though. If we're looking at just net profit margin, it looks like we're doing well, we're doing good. But if we look at how much this is a company that they've invested, like it's capital extensive. Like if you look at, is it extensive or be intensive? Hey God, capital intensive. So if you look at how much they have invested in that business and you do the ROE, you realize that it was like there's no point. It was like we're just playing.
Exactly.
So sometimes this profitability ratio, you shouldn't use one in isolation. Like use like the three of them arranged together.
Yeah, absolutely. In fact, that is very key, especially because I think for me, the gross profit margin is basically what the production manager would want to know. What our revenue to costs, ratio.
Yeah.
How efficient are we in producing, in managing, and all of that. But the general manager of the business might want to know the net profit margin. How efficient are we in overall operations? Yeah. I hope rent is not taking so much of money and all of that. Now, all those ones, they are the people that are managing the business. The people that own the business, what they are interested in is returns on equity.
Exactly.
This is like this. What is the percentage? What is it looking like? You see. So I mean, you can bring a 50% gross profit margin, and then come and have a very minimal return on equity, because by the time you are looking at the net profit compared to shareholders' investment in the business, the percentage is very low, right? So all these are, in fact, these are the basic profitability ratios that you should probably put a formula that is a standby dashboard on your Excel. Every time you're making your report, is showing and all of that. So you know how to balance your celebration. You should not see a 40% GP and say, oh, no. And then by the time you come to ROE, you're seeing 2%.
Yeah, oh exactly.
Okay. Yeah. So thank you so much for sharing that experience. That was very spot on.
Yeah, thank you.
So for instance, a company with high gross profit margin will indicate efficient production and pricing strategy. I've already mentioned that strong NPM will always suggest that there is effective cost management or there is good revenue generation. And then a high ROE shows that the company is generating good returns for its shareholders, right? So you can, with your NPM, you can look through because usually one of the ways of analyzing the triggers of your NPM is to check your expenses. What are avoidable expenses? What are avoidable expenses? especially maybe you are in a factory that maybe runs production shift, right? And
Mm-hmm.
let's say um, maybe you have like 10, yeah, you have 10 employees, and the factory capacity is such that all 10 employees can work at a particular time, right? The factory capacity is such that all 10 employees can work at a particular time. Let's say to incur more diesel costs, you're going to incur more light costs, you're going to incur more operation running costs. You can just run one shift, pay them up, and allow your factory to rest. So you run one shift that does massive production that can cover for the other shift. And again, that's going to be a function of, are you dealing with perishable production, or is it just in time production, or is it based on order, all of this kind of thing. But your NPM will always help you look into your costs. What are the things that can remove? What are the things that can reduce? What are the things that can
Exactly.
improve on? And all of that. And then, yeah. Okay. So, efficiency ratio. Well, there are a lot of efficiency ratios that we could always talk about. I think, please confirm you can still see my PowerPoint.
Yes, I can.
Okay. Yeah. So I think some people usually look at net asset turnover. That's your um, total sales over your net assets, right?
Okay.
Your net asset is total assets minus total liabilities. Some people usually look at that. And then I think some people also usually look at your um, inventory turnover ratio. Yeah,
Mm.
your inventory technically, now efficiency, of course, we know that in management, I don't know if you still remember, hello, I don't know if you still remember I was just saying hello to my wife, she passed by.
Oh,
I,
okay.
yeah. So I don't know if you still remember, when we did management, strategic management, there's usually this thing about efficiency and effectiveness, right? I would say it's not about being effective, you
Yeah,
also have to be efficient.
exactly. Yeah, I remember. I remember.
Yep. Yeah.
It's
So
not
they
about
say
doing. It's not about
effectiveness.
doing the wrong thing right. It's about doing the right thing. Something, something. Yeah, I
Yeah. Yeah. So they say effectiveness is doing the right thing as at the right time.
mm-hmm.
But efficiency is doing the right thing such that you save time. So
Yeah.
that's what efficiency looks at. Effectiveness is that maybe it takes 5 hours to deliver on this job, and you do it very well. You deliver it in 5 hours. There was no mistake. There was no. But
Mm-hmm.
efficiency is that you found a way of delivering it in 3 hours, and everything was still on spot, beautiful, and
Mm.
all of that. So also in your financial reports, there are some that could speak to how efficient your business is, right? And mostly it will have to do um, with your inventory. It will have to do with your. It's usually a measure of turnover. And then let me put it that way. It's usually a measure of turnover. What's net asset turnover? What's inventory turnover? And all of that. So net asset turnover speaks to how much your sales covers your net asset. So if we are looking at the net asset of the business compared to the sales we make, does that sales cover our net asset? Imagine having a net asset of say maybe 10, 10 million, having a net
Mm.
asset of 10 million, and then making a sales of say maybe 500,000.
Mm.
Are you efficient? No, you're not.
No.
It means you
Yeah.
have big capacity that you're
Uh-huh.
underutilizing.
Yeah.
You
Yeah.
get. So
Mm.
that's what efficiency is technically talking about. Right? So if you look at inventory turnover, it looks at your cost of goods sold all over average inventory. So let's say you have an average inventory of 500,000, but your cost of goods sold was like um, let's say maybe you had a cost of goods sold of like 100,000. So it means that one way or the other, you've not fully maximized your production capacity. So it usually indicates how effectively a company manages its inventory level and how quickly it can convert inventory into sales. So this will always be very good for a very good indices for manufacturing companies, people working with FMCGs, and all those kind of places. Yeah. So a high ITR suggests that the company is efficiently managing its inventory by quickly selling and restocking goods, which can help reduce or can help reduce carrying costs and improve cash flow. So, like the illustration I gave before, imagine having a cost of goods of say maybe 100,000 and an average inventory of say maybe 500,000. Means you're just like 20% efficient. But
Yeah.
imagine having a cost of goods sold of say maybe 1 million and an average inventory of 500,000. My God, it means you're what? You're like super efficient.
Yeah.
You're turning it out quickly, selling it very well, and all of that. It's just so beautiful. Just so beautiful. Yeah.
Okay.
You know, I just love these things. You see the way I'm speaking, it's passion about them.
Yeah.
You just see that it's something that can be relatable, it's something that can be practical, it's not out of the blue. It's as beautiful as an apple. Just have an apple bite or a carrot bite. All right. Yeah. Okay, so let's also look at accounts receivable turnover ratio. Yeah, this is also a very good way of measuring your business efficiency because you want to see how well you can collect debt. You want to see how well you can recover your receivables so you wouldn't always have to run into cash problems. So it shows how efficiently a company is managing its credit sales and collecting cash payments from customers. I want to run fast so that because the pick for me is showing people how they can just set this thing up on Excel, just use formula and do this thing. I mean, you can always read this up. So these are some few applications from some few applications. So for inventory turnover ITR, a high one would always imply that the company is efficiently managing its inventory levels. Maybe it is minimizing holding costs or quickly converting inventory into sales. So these are the things you look at. For the low one could maybe excess inventory levels, slow moving products, or inefficiencies in inventory management. So if you see a lower level, you're like, why is this thing low? Is this one not moving market? Is this one not, and all of that. Same thing with account receivable. Higher, in fact, for efficiency ratios, the higher the better in most cases. High rates might indicate that company has effective credit policies and collection procedures. Now, it is very important. People say if you don't stand for something, you fall for anything. If you don't define your standards from beginning, people will give you their own standards. As a business, and especially as an accountant to a business, you always have to suggest debt policies and standards. It's very important. In fact, it should be part of your LOE so that you are not doing job and then you don't know when you are going to collect money.
Exactly.
Or money collection will become prayer point. It should be part of the LOE.
Yeah.
Yes. So if I pick your FS and then I have a high account receivable turnover ratio, it means there's something in place within this company that makes debt collection faster, and then there's a better collection procedure and all of that. But if it is very low, it could be that there's poor policy in credit management. There's usually delayed payments from customers, and probably there's no system around to all of that. So as you're watching this video, I'm giving you inspiration now. As you go back, tell your guy, these are our invoice that we used to send, that will just give blanket dates. No, from henceforth, we have to enter engagements with clients. For our services, payments for services are due at most 15 days after final completion. So those are policies. They should sign, you sign. It becomes a legal document and binding. Right? Don't go and be doing work and you are now begging customers to pay. Who does that? Don't do it again. In this 2024, no grief for anybody.
No grief for your customers.
No grief for your customer. Give them good job and they should pay you well.
Yeah,
All
yeah.
right. So we've come to interpreting financial ratio. You see, I thought it was going to be very fast.
Yeah, it was.
Interpreting financial ratio. How do you interpret the accounting ratio? This is the Oga Patapata of them all. It's not
Mm,
about 10%, 20%, 50%. Nobody's
exactly.
interested in the number. What sense can you make of it? And of course,
Mm,
you know that even ICANN exams, calculation is usually a smaller mark compared to interpretation.
exactly.
Interpretation carries a higher weight than calculation.
Mm-hmm.
So know the calculation,
Mm.
know the interpretation.
I
In fact,
miss
my
ICANN
lecture was always
exams.
application. No, I don't miss it. I don't miss
Ha!
it.
No,
I
to
move
be
on.
honest,
I don't like it.
I kind of miss it. Oh goodness, those days. Ah, shit. We thank
I
God for
move
life.
on. Uh, no, but actually, I loved it. It was good fun.
It
It
was
was good fun.
challenging. I think I love
Very
challenges.
challenging.
Yeah, it was challenging for me.
Very, very
And
challenging.
the icing on the cake is that point when you see your result. That joy, like finally, after all this hard work, I passed.
No, it's
Oh
very
goodness.
interesting.
Oh
It's very
goodness.
interesting. I just used to sit back and like, so I can meet. I think I got inducted 2017. So I
Wow,
just sat
that's a long
down
time.
in
That's a
the
long time.
that's a long time ago, yes. It's really a long
Wow.
time.
Wow.
So I sat down in the hall and I was like, oh, so it's done.
So this is
Like
it.
I'm chartered. This is it.
The time when you are taking the exam, it look like it will never end. You'll be like, when will this whole thing end?
Yeah.
Like, God,
Yeah.
I feel like
Yeah.
I didn't dance enough for my induction for the stress that I went through. I should have soon at
Me, I
that.
didn't even I was already too stressed. I just wanted to collect the certificate and go.
Oh, goodness. Good memories.
No, actually good memories. And I think then when I was taking ICANN, sometimes I used to think about the practicability, like how is this applicable? But now,
Mm,
in the industry, having to work with different accounts, different, I'm like, wow. So this is that thing they used to say in ICANN. And the thing will just be dawning like light. See, no
yeah,
knowledge is a waste, really. No
exactly.
knowledge is a waste.
Exactly.
It helps you add value. Sometimes I do ratio and I'm like, wow, this is very, it makes sense. It makes sense.
Mm-hmm.
It makes sense. All right. So in interpreting accounting ratio, there are two things that you have to keep in mind. You have to consider industry standards and also consider trend. So every time, maybe whether in ICANN, whether in real life, when you come across or when you're dealing with ratio analysis, first thing, what are the industry standards? That's why if you're approaching maybe an ACCA or ICANN exams, you will notice that I think mostly ACCA does that. I can also do it. They will usually give you some industry benchmark within the story. They are giving you one long story that will end in ratio analysis. They'll tell you other companies in the industry are doing so percentage.
Mm-hmm.
That is giving you a clue that by the time, in fact, sometimes they won't tell you what ratio to measure, but they will tell you other industry ratios. With the other industry ratios, you know what kind of ratio to do, right? So
Yeah.
if I'm given that other industry are doing a net profit margin of so percent and a gross profit margin of so percent, and they are giving their shareholders a return on equity of so percent, they have already told me what profitability ratios to measure. It's
Yeah.
usually confusing for people when you are asked to measure profitability ratio. You are not like,
Mm-hmm.
which one should I measure? They didn't tell me whether I should do this one or that one. No, just look at the question. What are the industry benchmarks that are there? That should give you a clue on what to
Mm.
measure, right?
Yeah.
And then also look through the specific case. Um, are you trying to observe the pattern of, are you trying to observe the pattern of profitability in terms of efficiency in production process or efficiency in cost management? That's also going to inform you. So whatever is the goal, you define what kind of ratio you need to build and the interpretation to give. So these are the two core, as you can see on my screen, these are the two core: benchmarking against industry standard and trend analysis. So benchmarking against industry standard is like comparing a company's financial ratio to that of industry peers and competitors. the company I used to work for, a very big real estate company, and they don't call the other guys competitors. They call them friends. They say, no, they are not our competitors. They are our friends.
Our friends are really okay.
They say it's friends. So we look at what they are doing and we get a clue of what
Mm,
we should do. We are, they don't call it, they say without competition, we'll be out of business because they are the ones that are
mm,
keeping us on our toes. So they are our
yeah.
friends. So if that is your case, no problem. You look at what your industry friends are doing, and then you can assess your performance based on that. And then you can also look at deviation from industry. There's usually industry benchmark as well, right? The industry benchmark. I mean, there's something that makes the Big Four accounting firm called Big Four. There's some industry benchmark in terms of number of employees, revenue, all of this kind of factors, and all of that and all of that. So you have to consider that too. Then trend is when you're looking at or you're observing movement. For those of you who trade currency or who trade stocks, you notice that you're always paying attention to those zigzag lines and all of that. Those are like trends. They involve tracking performance over a period of time. So when you're talking about trend, you have timelines coming,
Mm,
right? And to be a very awesome accountant, one of the things you have to do is just provide comparatives when you're providing reports. If you're providing monthly reports, it's good to provide comparatives, say maybe 6 month comparative or 3 months. Just build it in your template. You don't have to do the groundwork every month. Build it down in your template, provide comparative. It helps management have a better idea of everything and to notice trends. So with ratios, you can also, track trend, plot trend, analyze financial ratio, how they change from period to period, identify patterns, potential areas of improvement or concern. You see, so consistent improvement or deterioration in financial ratios can provide valuable insight to what is happening in the business generally, what is happening in the market, what is happening to your product, and all of those kind of things. So I've curated some examples that we can consider if we're
okay.
analyzing or interpreting financial ratios. So first here, I say company with lower profitability ratios may suggest that it is less efficient or competitive in generating profit compared to its peers. As simple as that. So if you have lower profitability ratio, don't crack your brain too much in exams. Just say it's less efficient, right? You can compare it to if they give you a comparative of other companies. If it is real life that you're dealing with, look for one or two other companies that are maybe publicly listed or within your industry that you have their information and you compare it that. Now, if a company's efficiency ratios exceed industry standard, may indicate a competitive advantage in managing resources and operations. These are things you brag about. And this is why ratio analysis is important because you give it's a flow. With this information given to management, management can give to people in say maybe PR, publicity and all of that, and they have a way of projecting our business did so compared to industry, or we have efficiency of so level, right? And if a company's liquidity ratio has been steadily declining over several period of time or quarter, it may signal deteriorating liquidity position and potential cash flow challenges. So that gives you an idea. If a company has higher return on equity or lower debt to equity ratio compared to its peer, it may suggest that it is more profitable and has a stronger financial position than its peer. You see. So it was a typo there that should be done.
Okay.
You see, so a higher return on equity means I'm giving my shareholder higher return, and then a lower debt to equity ratio. Of course, it means I'm not using more of my profits to service, so I'm not debt driving my business. So that could mean
Mm,
and it's a good catch for getting more investors if you want to, or for projecting effective management, and maybe revenue growth strategy. So these are just giving you scenarios, because sometimes when it comes to interpreting ratio, people are usually very scared. They don't know what to write.
Yeah, yeah, I
People love
agree.
the computation, but when it comes to interpretation and application, it's a challenge. Don't you crack your brain too much. Just look at those numbers and say something. If the numbers are favorable, the business is favorable. If the numbers are unfavorable, the business is unfavorable. Now, what are the unfavorable things that can happen around a business? Poor management, high cost, and slow moving products. Just think about all those scenarios, you see, and apply it, and you're done, right? Okay, so let's look at a quick practical application. Um, we should be rounding up very soon. I don't want to
Okay.
keep this longer. So
Okay.
after this, we'll just look at Excel and then the wrap up. So let's say company XYZ, which is owned by Pepe. It's a publicly traded manufacturing company
Okay.
operating in the automotive industry, right? The company has been experiencing declining profitability and liquidity challenges in recent quarters, prompting concerns from investors and stakeholders about its financial health. So now you have been approached as a professional consultant that you are, and you are asked to assess company XYZ's financial performance. How do you do that? Now let's walk through everything we discussed in our ratio analysis. I call this my six C's. I would have put a seventh one, but because of this, don't worry, I'll give you the seventh one as a bonus.
Okay.
So I say collate, calculate, compare, conduct, connect, convey, right? And
Mm-hmm.
then correct is the last one, and I'll say what that correct means. Putting measures to control. So first, collate financial reports, collect all relevant financial information that you will need. Technically, your SOFP, your sorry, I should not be using jargons. Your statement of financial position, your statement of profit or loss, another comprehensive income, maybe your cash flow statement. Yeah. So you collate all of that, and then for the latest financial period, we want to assess their performance like for the latest period. Then it now calculates key financial ratios. So if you are speaking about profitability, mostly you need your SPL, your statement of profit or loss. So you need your SPL for your GPM, for your NPM, and all of that.
Mm-hmm.
Then you need okay, for equity you get that from SOFP. So you need your SOFP for your returns on equity or returns on capital employed. Then compare to industry, always get industry benchmark. You see, it's good to compare to industry benchmark and peer companies to access the relative performance and competitive positioning. It's always very important, very, very important. Because if you do um, an intrinsic processing called like an internal review. It could be that they're doing well, but what about an external review compared to other companies in the industry? Are they doing well? Identify
Mm-hmm.
significant deviations from industry norms and analyze implications for the company's financial health. Now, next thing, conduct trend analysis. Very important. Observe the movement. At least that's why usually in financial statements you have your 5 years analysis towards the end of the financial statement, because it's good to observe the trend. How is the business moving? Analyze trend over multiple periods to identify patterns, changes, potential areas of improvement, and all of that. Then connect the dot. This is where you're coming in as a consultant, having compared to industry. This is where the business is. Having observed the trends, this is how the business has been moving. This is what has been the major driver. Now begin to connect the dots, identify weaknesses, key areas key areas such as maybe profitability, what is driving profitability, liquidity, what is causing liquidity. Do we have more current more current liabilities compared to current? Just connect the dots. That is bringing your interpretation. Then convey what is the to do. What this means is, what should management do with this information that we provided? What should be done? This is where recommendation comes in. And then the last step I said is correct. Put measures to control monitor and maybe correct applications where the need arises.
Okay.
All right, so we go to building on spreadsheet. Is it Excel screen showing now?
Yeah, it is.
Oh, beautiful. All right, so um, this is a very simple scenario, nothing much. The goal of this is let's just demonstrate everything again. Talking is not going to be, it's not going to take long. So remember our 5 steps. First, we say what collects all the financial statements. So let's assume you already have your financial statement. So this is your income statement, otherwise known as your statement of profit or loss, right?
Yeah.
Um, so we have revenue, cost of sales, all of this, all of this, all of that, and you have this. Then you have your balance sheet, statement of financial position, um, and then you have all of this, all of this, all of this, all of this. So I'm doing this for 5 years, right? We have like 5 years. So let's start with the 4 ratios that we talked about. We've talked about liquidity, we've talked about solvency, we've talked about profitability, and then we've talked about efficiency. So I'll just do a quick one with liquidity. So let's go to our ratio analysis box. Let's say um, okay, let me use this. So let's say we want to start with our liquidity ratio. So we
Mm-hmm.
had our current ratio, we had cash ratio, we had all the other ratios and all of that. So what's our formula for current ratio? Current asset over current liability. So what's your current asset for year one? Your current asset is what?
Scroll up. 3751.
So we can see our total current asset is 378. What's our current liability? This is our current liability.
7518. Yeah.
So let me try to put some percentages to this. All these buttons should leave my screen. Okay. I have to reduce this so that the
Okay.
Zoom tools were not allowing me to
Oh,
do
okay.
my. Okay, so let me make this in percentage. Usually, yeah, let me make it as number 0.5. Great. So you've said your current assets minus your current liability, and then if you spread it across, it shows you. So you can see your current ratio for year one was 0.5. So it means that 50% or your current asset actually can cover 50% of your current liability. That's not a healthy position, actually.
Mm.
And if your current ratio is supposed to be the highest of all the ratios. If
Yeah.
your current ratio is 0.5, what will your asset test ratio be?
Exactly.
What will your
Exactly.
cash ratio be? Do you get?
Mm-hmm.
So you can see as simple as that. How do you do current asset? Sorry, asset test ratio. That's supposed to be your what? Your current asset minus inventory. So you come here. Where do you have your current asset? This is your total asset, and then your inventory is this all over your current liability. As simple as that. Something divided by this. I know this will be way less. This is gonna be
Yeah.
lesser because as you go further, it just keeps reducing. Then I can drag through. You see, where the current ratio was 0.5, quick ratio was 0.3. This is a very risky position. Where the current ratio was 0.7, quick ratio was 0.5. So with this, you can just have a bird's eye view of how your business is performing. What was the other ratio we did? We did cash ratio. Now let's
cash
see.
ratio.
So for those of you just watching, this is how you can easily duplicate this, insert copy save, and then I can just turn this to cash ratio. And what's the formula for cash ratio? You just have a cash.
Those marketable security.
Yeah, this will include marketable securities all over your current liability. Since it is plenty, let me increase it a bit. Increase some more. Yep. All right. So we go back. What is our cash or cash and cash equivalent? So we have these and these. I would say short-term investment because it's somewhat like a marketable security. It's easily convertible, e.g., all these 30 days treasury bills, all this kind of stuff. So I could consider it. This divided by my current liability. There we go. Oops, our business is not doing well.
Yeah.
Our business is not doing well, guys. Guys, you need to speak to this CEO. This business is not doing well. You need to speak to the CEO. So please, we have our liquidity ratio, and you can see the overall position of the business. So you can build a dashboard like this, very simple, on your workbook, and off you go. All right, so let's look at the next one. I think we had solvency ratios. Yeah, so let me take my next table here and call it solvency ratios. And we had, what was the solvency ratios? We had our debt to equity ratio.
Yeah.
And we had our, so let me start with
assets on, that's efficiency.
Yeah, debt to equity. Don't worry, we still have our spreadsheet here to guide us. So our solvency ratio, we had our debt to equity ratio, and then we had our interest cover ratio. That's our. Can you still hear me?
Yes, I can.
Okay. All right. So our debt to equity ratio is definitely our total debt. Total debt all over our shareholders' equity. All right. So now, what's the total debt? Please note, this is not total non-current liability. It's very important.
Yeah.
Please note this total debt. All right. So because you can see in our non-current liabilities, we have long-term debt, we have minority interest, we have other long-term liabilities. So what's our interest here? We're looking at our debt, and then in our non-current liability, we have other debt. So this is what we're looking at, divided by our shareholders' equity, total equity is this. Well, this is not so bad a position. Not so bad. Not so bad. Wow. In year 4, their position was way better. Let me copy my format from there. apply to all of this. So I like consistency in my presentation. So
Yeah.
all right. So this is our debt to equity ratio. We can see that in year one, total debt was about the business was like 57% debt driven, right? And that's not so bad. That's not so bad. But in year four, the debt was so high. That was like a 1.23.
So
Wow,
what happened for
that's
the
high.
increase?
So now we can drill down. If you go back to here, you will notice that shareholders' equity has actually been increasing over the 4 years, but at the same time, debt has been increasing. Can you imagine? Year four had the highest debt, 12, about 12 million pounds. That's a lot. That's a lot, you see. And then the debt level here, the short-term debt too, about 3 million pounds. That's a lot. So you see, that's the reason for that high. So by the time we're looking at our total debt for year four, we're talking about 15 million debt, whereas our equity is 12 million. You see what we're talking about? So you can advise your company accordingly. So let's see our interest cover ratio. What's our interest cover ratio? Operating income all over interest expense. So once you define your formula and then you have your workbook defined like this, you have everything good to go. So where do you find your operating income? You come to here.
It's
That's your EBIT, income before interest and tax, divided by your what? Divided by your interest expense. Where is your interest expense?
so far.
This is your interest expense. So I just put a negative by the minus so that it's going to give me a positive value. So this tells me that not so bad, not so bad. So for year one, my operating profit can cover my interest expense like 9 times. In year two, like 11 times. In year three, like 10 times. Year four, you will see the significant drop. It dropped drastically. Remember, year four is a four with so much debt.
Yeah.
So it now drops to 6 times. And then year five, 5 times. So, I mean, just define the formula, define the ratio, and off you go. So, I see it's almost 1 p.m. I wanted to stop the session before 1 p.m. I
Okay.
don't know if to continue,
Yeah,
but I
please
would
continue.
say, okay, I can continue.
Yeah, you
All
can.
right. Okay, so let's look at efficiency ratio or profitability. At least once I do profitability, I've done a bulk of it because I love profitability ratios. So I preserve this one for profitability. Should be the beginning profitability ratio. So we have our gross profit margin. That's your what? Your GPM. And what's your gross profit margin again? That's your gross profit. Gross profit. For those of you who are not familiar with what gross profit is,
Revenue minus cost of sales.
yeah, and then your revenue. Your revenue is your sales. So this is very simple. It's okay to leave this one as percentage. Remember, I said your gross profit, all you need is you need your income statement. This is my gross profit. This is my revenue. And enter. All right.
Okay.
So you can put this to percentage. It's okay to leave this as a percentage. and add some decimal point. Yeah. All right. So we run through. Wow. Year one, year two. So you can see with this gross profit, if you look at the trend, the business has not so much been growing. Year one is 7.6%, that's approximately 8%. Year two, and 8.1%, that's approximately 8%. Year three is 7.6%, that's approximately 8%. So if I'm to take out the two decimal places from this, you see that it will be showing me an 8% performance across board.
Mm.
You see,
Yeah, yeah.
8%. So it looks like the business has not been performing. So you can now want to drill down. Is it that we maintain same revenue, or you can notice that they were increasing revenue. Revenue was increasing over the year. So if you were doing a revenue analysis, it would look like revenue is increasing. But at the same time, cost was also increasing so much. In fact, if you look at the gross profit margin, it shows you that in some cases, the gross profit was almost static. In year one, between year one to year two, there was just a very infinitesimal increase in gross profit. And then year three, it dropped again. Year four, a very little increase. And year five. So you see how all of this plays out. So with this, you can look at your business and say, wow, we are doing well, or we are not doing well, or what do we have to change? If our revenue is increasing and cost is also increasing in a higher proportion, because if you want to do a quick analysis of revenue change, okay, let's just do a quick analysis. Let's say this minus this. Sorry,
It's fine.
is trying to look at it from a holistic perspective. This minus this. Let me put my percentage. Yep. So if I want to look at revenue increase year in year, you would see that yeah, to be sure, yeah, to be sure. Yeah. Now you can see that the year with so my comparative is prior year actually. I'm not pinning it down to 1 year. My comparative at every point is prior year. You can notice that year three with, let me position this number, let me write a line and add some decimal point. So you can notice that year three that has year three, yeah, year three that has a 13.9 revenue increase still had a slight increase in gross profit margin. See, so if you were to do analysis by increment in revenue, you might be, oh, we are doing well, we are doing well. But if you go down to gross profit margin, you notice that this was like 7.76. So production might not be efficient, pricing might be very weak, all of those kind of things. Now, let's look at net profit margin. Remember our adage. This is your net profit all over your revenue, and to always be, in most cases, lower, way lower than your gross profit.
Yeah.
And then let's do our returns on equity, NPM, ROE. All right. And then your returns on equity is going to be your net profit or shareable profit, all of our shareholders' equity. All right, having done that, Let's do the math. What's your net profit? Your net profit or your net income is this. What's your revenue? Your revenue is this. Let me copy this formatting. Beautiful thing with Excel formula is once they are built in, drag and click and drag and save the number of times. So you see, we can see the 7.6 profit margin, gross profit margin, the 3.9 net profit margin. Technically, it looks like the business does 50%. There's a 50% gap between its net profit and net profit margin and gross profit margin.
Yeah.
For instance, gross profit is like 8%, net profit is like 4%. And if you look across board, it's the same thing. If I was to reduce this to, say, maybe a 1 decimal place, you would notice that while the up will be a 8%, the down will be a 4%, except for year 3, that is a 5%, right? Okay, and then let's see what the business is doing for its owners.
Okay.
How
Return
well?
on equity.
Yes, like Pepe said. Let's see if the owners, the owners' money is well invested.
Yeah.
They do all over total shareholders' equity. And let's see how it goes over here. Well. You can see year 4 and 5. Can you recall what happened in year 4? There was a high borrowing in year 4. So you can see year 4 and 5, owners' equity started to drop, started declining. Started from a 16.8%. We had an 18% in the 2, so performance in the 2 was quite encouraging. And then an 18%, a 16, a 16. So, but in average, let's say this business is relatively profitable, right? But the liquidity position of the business is very weak in average. The liquidity position of this business is very weak. We can see the cash ratio. The business cannot sufficiently cover its current liabilities with its current cash. Likewise, its current ratio, asset test ratio, and this could be, like we said, weak debt control policy, slow moving inventories, and all those kind of stuff like that. Anything around poor management and all of that. So these are your profitability, solvency, liquidity, putting them on Excel, having a very clean report that once you go for a meeting, you can just close this and say, all right, welcome everybody to today's meeting. Hope we're all doing fine. I'm so excited about today's meeting because I'm going to show you the performance of the business. And here is our 5-year performance report. This is our income statement. You speak to the numbers, blah, 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 blah. When you're done, you can close the income statement. This is our balance sheet. You speak to it, blah, 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 blah. This is our asset. This is our liability. This is what happened. This is what did not happen, and all of that. Now, the most interesting part. Now, let's look at our ratio. This is our business position in terms of profitability. We did a 7% in gross profit. That means that we made more sales compared to last year or this or that. You can now find out the driving factors. We notice that constantly our gross profit margin has been 8% approximately for the past 5 years. And that is because of this, or because of that, or because of this. This is adding expert touch to your report. So my people, I have come to the end of this presentation, and I would like to know if you have any question, please put in the comment section. If you have any comment, your most preferred ratio, and your experience working with ratio. And I hope the session has been very valuable. I and Peps would like to hear from you. Please let us hear your comment, let us hear your feedback, and very important, share this knowledge. share this knowledge. It does not bite.
Exactly.
So share
Exactly. And it's
this
free. And it is free.
and
It's not,
it's
we're
free.
not charging you for
And
it.
it is free.
Mm-hmm.
It is free. Oh. You see, I'm emphasizing it is free because when you start charging, now that it is free, take advantage
Enjoy.
of it.
Thank you so much. I mean, you really. I mean, this was giving like a regular Big Four training, like those training where you pay like hundreds of thousands to join, because how
Mm-hmm.
detailed and thorough it was, plus
Mm-hmm.
the real life scenario. Like
Yeah,
I honestly cannot thank you enough. This is really good. Thank you so much. Thank you.
you're welcome.
I don't know if you have
You're
any last
welcome.
word for the audience before you leave.
Um, Before we leave, I would just say understanding ratio, even in life, is very important. Myself and my wife, we did an analysis recently using dollar. We compared our earnings as at last year um, to dollar rate, and we compared it this year, and
Hmm.
we were shocked at the discrepancy. The discrepancy was humongous. Now,
Yeah.
when we were looking at figures, it was making sense, and we're like, no, all of that. But when we looked at ratio, when we did ratio comparative, our heart was skipping. So
Yeah.
remember, we think in pictures and in proportion. So it's very
Hmm.
important that you apply this proportional or proportionate aspect of reporting to your reporting and be that professional that stand out in your reporting. Thank you. Thank you
Thank
so
you so
much.
much. Thank you so much. Thank you.